chapter. Okay, thank you very much. We're going to continue on with chapter 2. We still had a small section of chapter 2, and then once we get through chapter 2 here, we'll be able to dive into chapter 3. We're holding at about a half chapter behind the syllabus, so I'm hoping at some point to close that gap. But anyway, let's just go ahead and see where we land here today as we get into chapter 2. Okay, so we're going to start to talk about the effect of information technology on an audit. And we start to talk about first is separation of duties. Okay, so if you have a client, they should be separating the authorization of a transaction from the actual recording of that transaction, the accounting records, to custody of any associated assets. Now, in an automated environment, we could see that you could combine some of those functions because computers don't order, television sets for themselves and take them home, right? Okay, so you might be able to combine the authorization of a transaction and the record keeping in an automated environment. Okay. Now, one of the key themes that we keep seeing when we start talking about an IT environment is the disappearing audit trail. So what happens? Storage costs money. If you're going to try to store something in a computerized system, there's a cost associated with that. So companies don't want to pay exorbitant costs to store all sort of accounting data, and so they may purge that data after a relatively short period of time. As I mentioned, I was on an engagement where we were looking at how the Federal Reserve Bank helps the federal government to account for the public debt. All Treasury securities get auction issued service through the Federal Reserve Banks, and they have an integrated accounting system, the IAS system, that essentially they purge all the data after 1 week because of all the volume of transactions. So if you're in an engagement like that, you need to plan accordingly. You need to consider the disappearing audit trail, and you need to be prepared to possibly use IT techniques that we're going to talk about to complete that audit, or at a minimum, ask your client to save information so that it'll be available by the time you get to your year-end audit. Okay, so that's the idea there, which is the disappearing audit trail. I don't think you need to flashcard that. That's pretty self-explanatory. Okay, all right, good. Now let's take a look. And even though they don't really lay these out this way, what we really have here is IT. Okay, what's going on with my pen here? Let's try that. What we have here is IT risks versus IT benefits. Okay, so what are some of the risks to a highly automated environment versus the benefits associated with that? Okay, and the opportunity for remote access is a risk. You say, well, gee, no, isn't that a benefit? Well, yeah, but what happens? Someone, and we're hearing more and more about these cyber attacks now, I guess they say they're coming through Russian entities where they're, doing attacks remotely from outside the country. So the more you have your data consolidated in an IT environment, the more you're exposed to some sort of hacking into the system. Concentration of information. Once they're into the system, it's not like they just got one file or they just got one general ledger book or something. They get what? They get all of the data once they get in. Decrease human involvement. Sometimes it takes a while for us to even know that there's been some shenanigans because there's not as much involvement. Also, if you have an error in program logic, it affects every transaction as opposed to just a one-time error that you might see in a computerized environment. And then disruptions can cause errors or delays, particularly if the entity does something like an engagement I was on, where they went and they backed up. We were looking at corporate credit union, and they did a backup of their system at the same time that they ran maintenance, and they corrupted the entire system instead of doing those operations in sequential order. So mistakes like that can cause a disruption. And if you're talking about a corporate credit union, that affected hundreds of credit unions and tens of thousands of clients of those credit unions. And so it can be kind of a big deal if something like that happens. Okay. Now, what are some of the IT benefits here? And you should flashcard them as risks versus benefits. Okay. Because that's generally the way the questions say, which of the following would be an IT risk? What would be a benefit? And you have increased supervision. So because you are getting more data, the data can be manipulated more easily, especially with a lot of the data analytic techniques now. You can have better supervision, oversight of what's going on with the entity. Okay. Okay, good. Now let's just take a look at the effect of information technology on evidence gathering from the standpoint of the auditor. And let's just go ahead and get a flashcard on the definition here of auditing around the computer. So what happens when you have a computerized environment, rather than use some of the computer-assisted audit techniques that we're going to talk about in a minute, what you basically will do is look at the input, look at the output, do a manual audit of the input, the output, and see if that matches the way the information was processed. That's called auditing around the computer. Okay, now what most entities will do, audit entities, audit organizations, CPA firms will do these days is they'll use computer assisted audit techniques. There are 5 computer assisted audit techniques that we're going to talk about here. I'm going to have you flashcard these, but the titles, the names that they give to these techniques are very, very descriptive. And so I think once you make these flashcards, you'll be in good shape. So the first one is transaction testing. And it allows the auditor to follow a specific transaction through the client system. So you put some sort of electronic blip or tag on that transaction, you tag that transaction, you follow it through the client system so you can see how it's processed. So you see how the description is a very good way of remembering, just by remembering the title of the particular computer assisted audit technique, you're almost remembering what it is that it does. Embedded audit module. Okay, with an embedded audit module, it allows the auditor to examine all transactions that maybe meet a certain criteria. For example, if your client tells you, well, we capitalize any expenditure on equipment over $500 or 500,000, in this case $500, then you would put an embedded audit module in the repairs and maintenance expense account, and it would automatically save off any transaction that's $500 or more, so that then you can come back and look at that and say, well, why wasn't this capitalized somewhere? So they call that an embedded audit module. Flashcard the 5 computer-assisted audit techniques that we're going to be talking about here. Continuing on to the next page, our third computer-assisted audit technique is test deck. Okay, now what we do with test deck, we go ahead and we run transactions through the client system, and this is done offline, and the transactions are basically going to be fictitious transactions that we run through the client system offline on the weekend or something to see that that transaction processes in a manner that's consistent with what our understanding is about the program, the application that we're testing there. Now, let me ask you a question. Do you think that running something offline on the weekend is giving you a true picture of how a transaction processes through a client system? And if you say no to that, what would be the problem?
No, because they usually don't have their full business operations going on during the weekend.
Yeah, and good, Travis. And not only that, but no employees. And how the employees interact with that data as it run through the system is what is maybe a critical piece of your understanding of the process, right? And so we have something called integrated test facility. And with the integrated test facility, now we run these fictitious transactions through the system, and it is done what? Online. It's done during the week. Now, why would anyone choose a test data approach when you could have integrated test facility, which obviously is going to get us a better picture? Your client may tell you, no way. You are not running those fictitious transactions through our system during our normal processing hours. You're going to crash my system. You're going to cause too much hell. And so what happens? Well, you would have to then go ahead and the advantage is with test data, it's not affecting the actual transactions in any way. But then if you use test data, you would have to somehow sit there and account for, well, how would it be different if the employees were involved, it was actually online. Okay. And then parallel simulation is essentially sitting there and taking the client data. It's not fictitious transactions now, it's taking client data, and it's basically using client data to run through a program or a process that the auditor has developed. So maybe you've developed some sort of program that is supposed to process the transactions in a manner that would be similar to how the client system would track those, would process those, and then you can simply compare the results. Parallel simulation. Okay, so again, you look at the titles, you have what? You have the embedded audit module, saving off certain transactions, the transaction tagging a transaction. You have what? Test deck, which is what? Offline, the auditor's fictitious transactions run into the client system offline. Integrated test facility, integrating the what? Fictitious transactions with the real transactions, that's done online. Parallel simulation, taking the client data and running it through some sort of program that the auditor has developed. Okay. Okay, good. Then we talk about generalized audit software packages, and there are several of these days. One that, I'm not as familiar with it because I didn't really know how to use it that well, but the system was called IDEA. So IDEA is a system where you can extract data from your client's system and then use that data to do your sampling, to analyze your transactions, etc. When we audited the public debt, when I was with the GAO, at that time, the public debt was only $5 trillion, okay? But we used a dollar unit sample, and we're gonna talk about audit sampling here probably next time. But we used a dollar unit sample, and if you had tried to pull a dollar unit sample on $5 trillion manually, you'd be there your whole life. With the generalized audit software packages, you don't need to know a lot about the client system. You simply will download the data or ask for some sort of data, download from them. They provide you that data, and then, or you may even let your generalized audit software package extract the data from the client system, and then you can do dollar unit samples, etc. And so the real advantage of a generalized audit software package, and let's just go ahead and flashcard the advantages here, it allows the auditor to sample and test a much higher percentage of transactions because the system, the generalized audit software package can go through and manually pull and electronically, pull those transactions. So then you can do whatever audit techniques you want on those. You don't need a lot of technical knowledge. These are, as you're probably aware, Windows-based applications, and it can significantly reduce audit time. Can you imagine taking a manual dollar unit sample on a universe of $5 trillion worth of transactions? Would be impossible without one of these generalized audit software packages. Okay. Okay, good. Flashcard those advantages, and then we've got ourselves a nice set of multiple choice questions here to get us started for tonight. Uh-huh.
Sorry, I just got off from work and I'm still driving. So can I skip the questions for until I get home, maybe 20 more minutes? So I just want to
Yes.
let you know that I will skip it.
Please don't
Thank you
answer the questions and drive at the same time. Drive carefully, okay?
Okay, I will get back later.
Okay.
Thank you.
Mhm. Okay, guys, let's go ahead and make a selection. Don't make me start to have to complain and stuff because you're not choosing. You know, Anne's driving, so she's got a reason. Okay, that's how it's going to be. I'm going to go ahead and I'm going to keep whining that you're not answering the questions. Maybe it's not clear why I'm hitting on this. I can see when everyone has given the response. Maybe you don't know that. And so when I can see that you've given your response, then I know it's okay to go ahead and call time and start answering the question. Whereas we waste a bunch of time and you know we don't have a lot. If I got to sit there and wait for people who are never going to answer the question because they're taking a nap or whatever the reason is that you don't want to answer the question. Okay, so please answer the questions. Okay, and let's go ahead and let's take a look at these. Okay, and we got a pretty, we got a pretty decent response if I share the results. Okay, pretty decent. Now, what I'm going to do is say the answer is A and stop the share so that when you look at the recording, you can see how this one worked. We say, which of the following computer-assisted audit techniques? Now, what are the computer-assisted audit techniques? We had what? Embedded audit module, transaction tagging, parallel simulation. We had integrated test facility, and we had test deck. Okay, so just by remembering that, and although I value creativity, I don't see how anyone could have picked data entry monitor because we talked nothing about that. Input control matrix sounds like, you know, some sort of cool science fiction thing, but we talked nothing about that. So I'm not seeing how D was even considered. So you should be looking at these saying, I'm taking the CPA exam today and I'm trying hard to get the right answer. So we're down to A or C, and we say that what? We'll be processing real transactions together without client operating personnel fictitious and real together without client personnel being aware. In other words, we're integrating the what? Auditor transactions, the fictitious transactions with the real transactions. That's integrated test facility. Most of you got that right. Okay. All right, good. Let's move on to question 2 now. Everybody needs to give this a shot. Okay, so let's go ahead. I'm looking for everyone to participate in this question, except Anne, who's driving. Okay, good. Let's go ahead and let's take a look at this one now. And we surprisingly didn't do as well on this one as the first one. I thought we would have maybe picked something up from that first one, but let's just go ahead and take a look. Most of us got it right, but we did better with question one. The answer here is parallel simulation. Okay, so let's just take a look here as we, okay, which of the following computer-assisted audit techniques process client input data? So it's client input data, right? So it's not the auditor's fictitious transactions. It's what? It's transactions that the client has, and we process it through a system under the auditor's control, a program that the auditor has written. That's what? Parallel simulation. We are trying to create a program that will process the transaction in a manner similar to how the client system does and see if we get the same answer. That's parallel simulation. So again, these 5 computer-assisted audit techniques are descriptive, and that we have what? We have the embedded audit module, we have the transaction tagging, we have the integrated test facility, integrating fictitious and real transactions. Test deck is what? Offline. We're going to be putting in real fictitious transactions to see how they process, but we do that offline. Parallel simulation is what? It's client transactions that are running through a system that the auditor is under control. Okay. Okay, good. You'll get used to those kind of questions. They're definitional to a large extent. You'll be in good shape. Just make those flashcards. Okay, good. Let's go ahead then and let's take a look at this next one. Okay, let's go ahead and make your selection. Okay, good. And let's just go ahead and take a look at this one. And okay, good chunk of us got it right. We're not quite at least 75% on some of these as I would like, but we're getting closer there in that, 67% of us got the correct answer. Okay, now let's just take a look at this one. And again, there's that word primary. So a primary advantage of generalized audit software packages is to audit the financial statements of the client that uses an EDP system, the auditor may, and I'm glad nobody picked D, because there is no such thing as required test of controls. We're only going to test the controls if we believe there's a potential that they would have what operating effectiveness, right? So obviously D is wrong, okay? Substantiate the accuracy of data through self-checking digits and hash totals. No, okay, that's nonsense. That wouldn't be something that you would use a generalized audit software package for. Generalized audit software package is going to allow you to do what? Extract data from the client system that you will need for your testing, whatever it is, okay? So then you come and you take a look at B. Consider increasing the use of substantive tests of transaction in place of analytical procedures. Now look, yeah, you probably could use what? More of a transaction approach for your substantive testing with these generalized audit software packages, because again, they can go out through and extract transactions and do some sort of procedure on those transactions. But that is not the primary advantage. It's what you have access information stored in computer files while having a limited understanding of the client's hardware and software features. The generalized audit software packages, again, the word generalized, are set up so that they can interface with many different accounting systems that are out there. Okay. Okay, good. Question? Okay, good. So with all that, let's go ahead and finish up chapter 2. We're done with that now. Okay, and let's start to take a look at chapter 3. Okay, now chapter 3 is an important chapter. A lot of point value here, some important, they're all important chapters, but chapter 3 is really central in that there's a lot of point value here, and also it is pervasive in that if you understand, you have to understand the things in chapter 3 to help you with chapter 4, chapter 5, as you go forward, okay? So let's just take a look though at the point values, okay? Fraud risk, 10 points. They are going to ask you probably a task-based simulation, a bunch of multiple choice questions on fraud risk. Audit risk, 10 points. They're going to ask you a significant number of questions about audit risk, and then your understanding of the elements of audit risk are then pervasive in that you have to apply that understanding to different areas of the audit as we move forward, okay? Now they get into evidence, and the book goes on a bit here, but that's not a heavy area, probably about 3 points, okay? Both the specific areas and specific areas of engagement risk really kind of go with these audit risks, sorry guys. But then when we get into sufficient appropriate evidence and procedures to obtain evidence, I'm going to give you 3 points there, okay? Financial ratios, 5 points. This is one area in which I'm going to ask you to study that on your own. I'm not going to sit here and read off divide current assets by current liabilities. That's the current ratio, but I am going to ask you to flashcard those ratios and make sure that you're comfortable with them. And then next time, we'll get into audit sampling, and that's going to be a 5-point area, okay? So you can see 2 big key areas up here, fraud risk, audit risk, okay? Now, what I'm going to do, and I don't understand why the book did this, why Becker did this, they put fraud risk before they talk about audit risk. And frankly, fraud risk is a subset of audit risk. So what I want to do is go ahead and turn us to module 2 first, and then we'll come back and we'll do module 1 here in a couple of minutes, okay? So just turn to module 2, I guess it's what, page 11 roughly, okay? And let's just go ahead and let's take a look at audit risk first. I guess I could have jumped to the page, but okay, so we're going to look at audit risk first, then we'll go back to module 1 and talk about fraud risk here after we've understood audit risk a little bit. Okay, now let's just go over and they tell us here. Let me put well, I'm not going to put myself in full screen mode yet because I want to do something here. Okay, what's all this? It's kind of nonsense. What is this? Okay, and let's just take a look at what is audit risk. Okay, and audit risk is the risk that the auditor may unknowingly fail to appropriately modify the opinion of the financial statements that are materially misstated. So as we said in chapter 1, you have a misstatement, you're going to qualify your opinion, right? You have a misstatement that's pervasive, you're going to give an adverse opinion. The audit risk is that there'll be such a material misstatement that warranted a qualified opinion, warranted an adverse opinion, and the auditor did what? Gave an unmodified, unqualified opinion. This is audit risk. Now, do you want the risk that you will make this mistake to be high or low?
As low as possible.
As low as possible. Good. And that's a good answer because what? You can never get it down to 0. So there'll always be some amount of audit risk. But we want it to be low, so we'll set it at, say, 0.05, low. That means we want there to be only a 5% chance that we will give what? We'll give an unmodified opinion when we should have detected a material misstatement and gave a modified opinion, okay? Now, it turns out that when we look at our audit risk, it's going to be the combination of something called inherent risk times control risk. We're going to define all these here in a little while. Times control risk times detection risk. That says detection risk because I had to squeeze it in. Okay, detection risk. It's going to be inherent risk times control risk times detection risk. Okay, now what will happen is the auditor will have to assess the inherent risk. The auditor will assess the control risk, and then the auditor will respond to those assessments by then setting up their audit procedures to keep their detection risk at a level that will keep their audit risk where they want it to be at a very low level, say 0.05. So in this example, I had assessed my inherent risk at the maximum. I had assessed my control risk at the maximum. And so what did I do? I tried to get a lower level, okay, lower level of detection risk, the risk that my audit procedure will not detect that misstatement. Now, coming over, okay, I could, let's see if it'll let me do it over here. I could make my assessments a little different. So let's say I'm looking at a client, and let's say their inherent risk is 1, the maximum. But now, just using a different color, and again, I want my audit risk to be low, so I'm going to keep it at 0.05 in this example. But now my client has a little better controls. So let's say instead of assessing that control risk at maximum, I assess it at moderate. I put it at 0.5. Then I can do what? Then I can accept a little more detection risk, okay, to keep my audit risk low. Now, never say a high detection risk, but I can get what? I can get a higher detection risk if I have what? Better controls, or if my transaction is not as inherently risky. Maybe I'm looking at fixed assets or something, okay? So what I'm going to do is I'm going to open up the supplemental slides that I had, and I listed them under chapter 2, but the ones we're going to look at are also going to be relevant to chapter 3 here. Okay, so even though it says chapter 2 slides, we're going to go ahead and we are going to review some things from chapter 2, but we're also going to sit here and look at the some of the new things here as well. Okay, so as we said back in chapter 2, step 1 in our risk assessment procedures is to obtain an understanding of the entity, including its internal control, sufficient to make a risk of material misstatement. If you assess the risk of material misstatement at the maximum, then you're going to go ahead and bypass the testing of the operating effectiveness of the controls, go straight over to the red arrow on the next page, and your further audit procedures will consist of just substantive testing, right? Remember, these are all key words that are bolded here. Now, if you have gone through your risk assessment procedures, which we also call obtaining the understanding phase, you always have to do that. And if you assess the risk of material misstatement at less than the maximum, then you'll follow the black arrow to the next page, and you will first do what? Test the operating effectiveness of the controls. That's why I say sometimes there, because if you have assessed the risk of material misstatement at the maximum, you'll bypass the testing of the key phrase, operating effectiveness, and you will go directly to your substantive testing. First test the controls, then not directly, but then go your substantive testing if you assess the risk of material misstatement at less than the maximum. And therefore, you always have to do some amount of substantive testing, right? Okay, we talked about that quite a bit the last couple times, right? Now, what we're going to start to understand here then is how will we use this audit risk formula to make the assessment of the risk of material misstatement. And you can see here that we have our audit risk, okay, audit risk equals AR. Our inherent risk is IR, our control risk is CR. Now, what happens? We basically say that our audit risk is equal to the risk of material misstatement times our detection risk. Now, when we talk about the risk of material misstatement, the risk of material misstatement is really the interaction between what? Between our inherent risk and our control risk. So when we say RMM, risk of material misstatement, which you saw on that previous slide, that's the interaction of what? Two components of audit risk, inherent risk and our control risk, okay? So what happens? You come over and you do your risk assessment procedures, and let's just look at this example, okay? Now, what happens? We're a very conservative CPA firm. We want our audit risk to be low. And you can say it in a qualitative term like low. You could quantify it, hey, 0.05, okay? Now, in this particular example right here, I'm pretending that I'm auditing a jewelry shop, okay? I'm auditing a jewelry shop. They have what? Very small, high-priced items that once you get them out on the street, they're pretty fensible, right? They're pretty easy to sell, whatever, right? So I'm sitting there and I'm saying, you know what? Bad economy, let's say, little diamonds and rings that are easy to slip into a pocket and take. So I'm going to assess my inherent risk at high, okay? Now, the inherent risk is something that the auditor cannot control. The auditor assesses the inherent risk, but the circumstances that lead to the assessment, you can't control, okay? Now, I'm describing something with a high inherent risk. Can you think of something that might have a lower inherent risk just based on the account itself or the item itself? Maybe an asset?
Something like cash.
Cash has the highest inherent risk. Cash is designed to fit in a pocket. And once you've got cash out the door, goodbye. Once someone reaches in and steals the cash is gone. You know, cash flow is the highest inherent risk.
I was thinking more
Jewelry.
of like some kind of service or service industry as opposed to something that sells a product.
No, service probably going to have a high inherent risk because the revenue recognition around service is probably complex. So no, a complex transaction has a higher inherent risk, right? Is it rateable? Have they earned it yet? Should it be earned over time, all at once? No. Something with a low inherent risk.
My second guess would maybe be cars, because it'd be something huge, kind of hard to get into. There's security behind it.
Okay, I don't know about cars because cars are attractive. Okay, so people may want to, misuse that asset, right? I work in a car dealership. I work, selling Porsches. I'm going to try to figure out how to sneak the 911 out on the weekend and then turn back the odometer at the end of the, weekend or something. But yeah, this idea of a large fixed asset, for example, a building, probably has a fairly low inherent risk because what? You're carrying a historical cost. And what? It's not very likely that someone's going to walk off with the building in the middle of the night. Okay. I was on the audit of the consolidated financial statements of the federal government. And when it comes to things like the Lincoln Memorial, the Washington Monument, they are valued at $1 and they are simply disclosed in the footnotes of the consolidated financial statements. So what happens? Low dollar value, footnote disclosure, and it's not very likely that someone's going to walk up with the Washington Monument in the middle of the night. However, you also have to look at environmental factors. So if you were concerned that they might be subject to some sort of terrorist attack or something, then you might go ahead and elevate that risk a little bit more. But I would say, yeah, buildings, larger fixed assets, they are more likely to have a lower inherent risk, okay? But in this example, we're auditing a jewelry shop and we're talking about what? Diamonds, rings, things of fairly high value that are fairly easy to hide in a pocket or something. And once you get out on the street with something like that, hey, you want to buy a watch, whatever, you can probably, get rid of that fairly easily. Okay. Okay. So we're going to set for this jewelry shop, we're going to set our inherent risk at the maximum. Okay. And maybe the economy isn't doing too well. And so we're worried that people might be more compelled to engage in some sort of, theft there and take those items. Okay. All right. Good. Then what? Then we look at the controls. And we talk to management because we have to obtain an understanding of the control sufficient to make the assessment of the risk and material misstatement. So we ask management, what are your controls? And they say, you see all these beautiful diamonds and rings and all that? Yeah. What we do every night, at the end of the night, we leave all the diamonds out, but we leave the lights on overnight, but we lock the door when we leave. And we're like, that's it? That's your controls? I mean, you're almost begging someone to smash the window and take this stuff, right? And so we don't like the controls. We make an assessment of the control risk at the maximum. So now we've got what? Maximum control risk. We've got maximum inherent risk. Our risk and material misstatement is at the maximum. So we're going to control our audit risk now by lowering our detection risk. And we set our detection risk at 0.05. So now, going back, since we set our risk and material misstatement at the maximum, what are we going to do? Follow the red arrow, right? And when we follow the red arrow, when we go to our further audit procedures, we are now going to go directly to substantive testing, and we are going to increase our substantive testing. By increasing our substantive testing, our detection risk, and guys, obviously I'm not an artist, but notice that Notice that our detection risk is down when we increase our substantive testing. Now, when we say increase in substantive testing, that's a very amateur way of talking about it, okay? What we say is we're going to affect our detection risk, okay, by altering the timing, extent, and nature of our substantive procedure. Timing, extent, nature, okay? Now, our nature means that we're going to use a more effective procedure. So we are going to talk about evidence later, but we will use external evidence instead of internal evidence, because external evidence is what is more reliable than internal evidence. So we're going to maybe send out some confirmations or something. Extent, larger sample sizes. So now we're going to sit here and we're going to pull a much larger sample of transactions. If it's a small jewelry shop, maybe we'll audit every single transaction during the year. Small jewelry shops, maybe have a couple of 3 items they sell over the course of the year. They maybe get a few inventory items in. So maybe we can do 100% audit of every single transaction. Extent, larger sample size, or maybe we don't even use sampling. Timing, now we're going to do our audit procedure at year end as opposed to some interim date before the year end. And I put this little drawing down here, and that for timing, okay, you can see right here that we have misstatements, and misstatement is a cloud, and the cloud is raining down misstatements on the financial statements. And if you don't have good controls, there's no roof protecting those financial statements. What we're going to do is let it rain, and we're going to put our substantive procedure at year end, and then we're going to squeegee off all those errors and find them at year end. Okay, so we'll do year end testing, larger sample sizes, and we'll use external evidence, for example, instead of internal evidence. Nature, extent, timing, that's how we control our detection risk through our substantive testing. Nature, extent, timing, those are our further audit procedures, right? Further audit procedures are the nature, extent, timing. I always say nature, extent, timing, because it gives us a mnemonic net here. Okay, question. Okay, good. So we finish our first jewelry shop. We go down the street and we audit another jewelry shop now. Now notice that what? Our audit risk is still low. That's a CPA firm policy. We're going to keep our audit risk at low. We don't want to have to go through all this trouble of earning our CPA license and stuff and then start driving drunk and setting our audit risk at a high level. Okay, so we're going to keep our audit risk low. Then what? We're still auditing jewelry shops. Let's say we specialize in jewelry shops, and so we're still dealing with a high maximum inherent risk. But now at jewelry shop number 2, we ask them to describe the controls to us, and they say, well, here's what we do. We have 2 employees come in together. There's always joint custody with our assets. One employee has the combination, the other employee has another combination. There's 2 combination pads on our safe. They have to open it together. When they take everything out of the safe, they are to take a full inventory of all the things, place them out on the display counters. A little bit later, here comes a supervisor in that oversees the process, and we can give the appropriate breaks. So there is always dual custody with our inventory during the day. At the end of the night, we take a complete inventory of everything. We log all that on inventory control sheets, and then we lock everything up in the safe. And then we have TV monitors watching the whole thing and recording in case there's any shenanigans that goes on. So we listen to that and we say, okay, that sounds pretty good. So I'm going to make an assessment of control risk at moderate. So my risk of material misstatement is no longer what? No longer 100%, it's 0.5. So now I can accept what? A higher detection risk. Never say high detection risk. By higher, I mean higher than the previous one. So now my detection risk comes up to 0.10. If my detection risk comes up to 0.10, now I've got a higher detection risk. So my substantive testing can come down. Now, what does that mean? Again, we talk about lowering your detection risk, increasing your detection risk in terms of what? Your substantive testing, nature, extent, timing. So nature, I can use now a less effective procedure. Now I can use internal evidence for my substantive test instead of external. Extent, I can use smaller sample sizes. Now, instead of auditing every single day's worth of transactions, maybe I'm only going to audit 50 days worth of transactions. Okay. And then what? And then timing, maybe I can do some interim testing now because it's not raining that much now on my financial statements because I have this nice roof. This is my internal control. So only a few drops are busting through. So what happens? I'll do my interim testing at 9:30 and get a lot of that work done before the year end. Now, that doesn't mean that you ignore the back end of the year. You'll probably do an analytical procedure or you'll take a smaller sample towards the back end of the year. We call that a roll forward. So you can't just ignore the back end of the year when you use interim testing, but the bulk of your testing can be done at interim. Okay. Nature, extent, timing. Now, notice that because I've assessed the risk of material misstatement during my risk assessment procedures at less than the maximum, now what? Now my further audit procedures will include the testing of the operating effectiveness of the controls. So what am I going to do? Well, as part of the obtaining the understanding phase, remember we talked about a walkthrough of a transaction. So as part of our obtaining the understanding phase, we would have gone ahead and done a walkthrough. And if we do a walkthrough, we would get there early and see that the two employees show up together. What happens if only one employee shows up and puts both combinations in there? How do you feel about that control?
Not oscillating effective.
Well, you are going to determine, okay, that that control was not implemented. So it's not only the design. I had to describe all this wonderfully designed stuff to us, but if it's not implemented, then you assess the risk of material misstatement at the maximum, right? And you go directly to your substantive testing. So a walkthrough is the way to see that it's implemented. If we get there early, and one employee puts in both combinations, like, design was nice, wasn't implemented. I assess the risk of material misstatement at the maximum. I go straight to the substantive testing. But if on the day of the walkthrough, they're on their best behavior, of course. On a day of a walkthrough, they put both combinations in. They sit there and they do the inventory control sheet. The supervisor signs off on it. And at the end of the night, they take another inventory, they put everything back. Okay, that control has been implemented. But all that tells you is that that control was implemented on that day that you were there. So now I'm saying, okay, I believe I have a potential that this control have operating effectiveness. So what do? Now you test the operating effectiveness. You follow the black arrow and you test the operating effectiveness. Okay, so what am I going to do? I'm going to pull, and if I wanted to test 50 days worth of transactions, what I would do is pull 49 more. Because remember, we said some procedures that are intended to provide information about the design can give us information about operating effectiveness, even though they weren't intended to. So I can pull that what? I can pull that 1 day's transaction, right? And say, okay, that day I did the walkthrough, that's one. Now, since I've determined I want to look at 50 days worth of transactions, I'll look at 49 more, and I'll go through those inventory control sheets and see if they were actually signed off on. And if they were, then I know that that control is operating effectiveness. And I will still have to do some amount of substantive testing, always have to do substantive testing. But again, now, nature, extent, timing, nature, internal evidence, extent, smaller sample sizes for my substantive testing. I went from testing every single day's transaction down to 50 days. And then timing, I could do some interim testing, although I will always have to do a roll forward. Question? Okay, good. Now, remember that we do everything in light of the assertions, okay? And so I'm going to go ahead and put this in slideshow mode just so you can see a little better, okay? And you can see here what we pick an assertion, we pick an account that we're testing, sales, accounts receivable, related account, assertion, existence, occurrence. We think of what would be a potential misstatement in that particular assertion, and then we assess the control technique. If we assess the inherent risk and control risk at the maximum, we will bypass the testing and operating effectiveness and notice that our substantive testing now is pretty full of different things that we're doing. We're trying to lower that detection risk. And you can see I put the audit risk formula across the top as well with the information to when you're doing that. Further audit procedures versus risk assessment procedures. If the control technique is a little better, and we've got a ghost in here now doing some things for me, so ignore those marks, that's not me. Okay, then what? Then we're going to go ahead and make the risk and material misstatement at low because we like the controls. If that's the case, we have to test operating effectiveness as part of our further audit procedures. But notice now that my substantive testing is down. It has shrunk down in terms of the amount of work I'm going to be doing for my substantive testing. So everything works around the assertion, right? Okay, question. Okay, good. Now you come over and let's take a look after all that. Let's just take a look at the outline and see where we can find some of this information, okay? Now, when we talk about misstatements, okay, there are different types of misstatements. So let's go ahead and take a look at that and make some flashcards around that. So you come down and you have, as part of your type of misstatements, okay, you have factual misstatement. There's no doubt, okay, factual misstatement. So what does that mean? I send out a confirmation to my client's customer saying, do you owe $25,000? The person comes back and says, no, I don't. And we investigate a little further, and it turns out that the client's accounting system is wrong. That receivable was paid off, and their accounting records didn't reflect it correctly. So there's a misstatement to which there is no doubt. Judgmental misstatements, okay, difference arising from the judgment of management and the auditor, okay, and the auditor considers it unreasonable, okay. Now this comes in estimates. Whose judgment are you going to trust? Your judgment or management's judgment? Who's right? Who are you going to trust? Your judgment or management's judgment?
I would say ours because our name's going on the audit report.
Yeah. Hey, sorry, management. You may say that this piece of equipment has a 20-year life. Sorry, everything I'm looking at says it has a 10-year life. Now, maybe management's got some mechanic in the back that can breathe life into an old piece of equipment. Whatever, we can't sit here and wait for another 10 years to see who's right. So we will say, hey, there's a misstatement because they're not using the appropriate number of years to depreciate this asset. Depreciation is an estimate, and we go with our judgment, okay? Projected misstatement comes because of sampling, okay? And what happens? There's always a chance that the sample will not be representative of the population, okay? So we've got factual misstatement, judgmental misstatement, projected misstatement, okay? And what we're looking is what is the chance that there will be a material misstatement in the financial statements. We won't detect it, and so we will unknowingly fail to alter opinion from unmodified, unqualified to qualified, adverse, whatever, right? Okay, all right, good. Now again, we can quantify that through the formula audit risk equals what? Equals RMM times detection risk, but we know that the risk of material misstatement, okay, we know it now from what we just looked at, is the interaction between the IR and the CR. So we will assess inherent risk during our risk assessment procedures. And inherent risk is what? Inherent risk is the susceptibility to a certain assertion for misstatement. Okay, again, when we look at financial statements, we look at them in the context of assertions. So what? complex calculations, cash is going to have higher inherent risk. Something like fixed assets, probably a little lower inherent risk. Okay? Okay, good. Now you come over and when we look at control risk, and control risk is the risk that the control will not prevent or detect the misstatement, right? And so when you look at the controls, make that assessment. Now, you come down and then we look at detection risk, and detection risk is the risk that the auditor will not detect the material misstatement. And some amount of detection risk will always be present because what? Because we probably won't look at 100% of the transactions. And even if we did, there's still a chance that there's some sort of effort by the client to outmaneuver us. So we don't have an S on our chest that says we're super auditors and no clients can ever get past us. So we will always have some. No part of the audit risk formula could be zero. Inherent risk can never be zero, control risk can never be zero, detection risk can never be zero. There's always some audit risk, right? And so detection risk, there'll always be some risk, probably because we're using sampling, but also maybe we just select the wrong audit procedure related to that assertion. We're human, we make mistakes, they hide things from us, etc. Right? Now we want to keep it low, but there will always be some detection risk. Now, when we look at our detection risk, it can be what? It is going to be determined by our substantive procedures, right? And when we look at our substantive procedures, we said this last time, I guess it was last time, our substantive procedures can be broken into two categories, which is what? We can have a test of details. For example, confirming account receivable. That says confirm accounts receivable would be a good example of a test of details, or it can be analytical procedure. I'm just going to call it AP. That's not accounts payable. That's an analytical procedure. Okay, so that's what they're saying here. It can be subdivided into test of details. Okay, but that's our substantive procedures. And remember what? Our substantive procedures are going to be up when we're trying to lower our detection risk. Okay. Okay, good. Flashcard, these two comments here about detection risk. Okay. And then I hate this passkey up here, but I have to say something about it. Let's just make our own passkey. Okay. And just put the auditor generally cannot change, got the N, cannot change facts that lead to the assessment of IR and CR. I'm going to read that back to you and flashcard that. The auditor cannot change facts that lead to the assessment of inherent risk and control risk. The auditor cannot change facts that lead to the assessment of inherent risk and control risk. Okay, so let me ask you a question here. Can I change the fact that diamonds and rings are easy to steal? Can I change that?
No.
I can't change that. Can I change the fact that my client has lousy internal controls? No, not on this audit. Maybe I can tell them, hey, you might want to do something different for next year. But on this audit, I can't change what they've been doing all year. I can, unless I have a time machine. So I can't change the facts that lead to that assessment, right? Can the auditor move around detection risk?
Yes.
The auditor can move that around. Look, if I'm sitting here and I'm saying, hey, I'm feeling lucky, I could go ahead and set my what? Set my audit risk at 0.10. And if that's the case, what? Then I'm not going to sit there and have to do more substantive testing to keep my audit risk at 0.10. Meanwhile, the guy who's a little more risk adverse and has his audit risk at 0.05, he's going to have to do what? Have to do much more audit testing to keep that audit risk at the 0.05. He's going to have to lower his detection risk by increasing his substantive testing. Okay, so the auditor can move detection risk around depending on how much risk they're willing to accept or their assessments of inherent and control risk, but the auditor cannot control the facts that lead to the assessment of the inherent risk and the control risk. Okay. Okay, good. Now, effect on the audit. And there is an inverse relationship to RMM to detection risk. So as RMM is up, what should happen? Detection risk should come down. That means what's up here? RMM is up, detection risk is down. To keep my detection risk down, what's up?
Substantive testing.
Good, substantive testing. And when we talk about substantive testing being up, it's what? Nature, extent, and timing. Nature, more effective procedure using external evidence instead of internal evidence. Extent, larger sample sizes. Timing, year-end. Good. So when the auditor determines that risk of material misstatement is high, detection risk should be at low. Conversely, and I'm not going to draw a picture of that, when the risk of material misstatement is low, there can justify, never say high detection risk, but you can justify a higher detection risk. Okay, and you can flashcard that just to remind yourself of the wording on that. So we give you an example here, and we say that if the auditor is trying to lower the level of detection, so these are things that the auditor does to lower detection risk: nature, extent, timing. Nature, use a more effective procedure such as external evidence. Extent, larger sample sizes. Timing, year-end testing rather than interim. And of course, if it's the opposite, then you can go ahead and allow some testing that is not going to be as significant. Substantive testing is not going to be as significant. It goes the other way. Okay. Always got to do some substantive procedure. Always. I don't care if you assess the risk of material misstatement at the maximum or not, or at the minimum or moderate, whatever, you always have to do some amount of substantive testing. Okay. Okay, good. We don't have to sit here and algebraically manipulate the audit risk formula. That's a little silly. Okay, and I'm giving you a better example. Okay, so let's just go ahead and let's just take a look at the interaction of audit risk and materiality. Okay, and so we have to consider them together. Now, we talked last time about materiality, but there is an inverse relationship between audit risk and materiality. Okay, now flashcard that, but sometimes students have a little trouble with that. This seems counterintuitive. John, explain that to me. Okay, so what happens? If I tell you that a 2-cent error could be material to the decision maker, to a decision maker's use, to a user's financial. If I tell you that a 2-cent error could make a difference to the decision-making process of a user of financial statements, would you be nervous about that audit?
Yes, very nervous.
Very nervous. Now, how am I going to find a 2-cent error, right? Okay. If I sit here and so my audit risk is way up because a 2-cent error could make a difference. What if I tell you that the entity has $150,000 of assets and a $10 billion error would not make any difference to the user of the financial statements. What are you going to do? Just sign the audit report. I'm not going to do any testing. Here you go. Just let me sign the audit report because there's no way that there can be a material misstatement in those financial statements, right? So my audit risk is way down because my materiality levels have come way up. Okay. Okay, now those are obviously extreme examples, but you get the point that there's an inverse relationship. Okay, I'm going to do question one with you because I hate question one and I just don't want to sit here and wait for you to mess this question up. Okay, inherent risk and control risk differ from detection risk in that, and the answer is they exist independently of the financial statement audit, and they really do a horrible job on this question. What they should say is the factors that lead to the assessment exist independently of the audit, right? And so what happens? The controls are the controls. The inherent risk is the inherent risk. I can't do anything about those. Whereas what? Detection risk, I can control however the auditor determines is appropriate in the context of the circumstances of that audit. Okay? Okay, good. Let's look at question two, because this one is a much better use of our time because you're going to see a lot of questions, both multiple choice and task-based simulation, that are going to test your understanding of how the assessments will affect the auditor's actions. And I want everyone to do this question now, okay? This one's important. Everyone should take a good shot at this question. This is the kind of thing you're going to see a ton of on the exam. Come on, guys. Okay, good. All right, let's go ahead and let's take a look at this one. Okay, and all right, 70% of us got it right. A few of us thought D was the right answer for some reason. Okay, so let's go ahead and let's take a look at this one. Most of us got it right. Okay, so on the basis of audit evidence gathered and evaluated, the auditor decides to increase the assessed risk of material misstatement from that originally planned. So what happens? Originally, I thought my RMM was down here because I thought my inherent risk and my control risk, right, is how we determine RMM, okay, was low. And so I was thinking, hey, I could probably take a little higher detection risk, substantive testing can be down here, right? But then when I did my walkthrough, two people put in the same combination. So I said, put in one, I should say one person put in both persons' combinations. So what happens? Now I'm saying, uh-oh, it's not that at all. My RMM, my risk of material misstatement based on my audit procedures, because I did a walkthrough when I was obtaining the understanding. Now what? Now my RMM is up. So what has to happen? My detection risk needs to be down, doesn't it? Meaning that what? Meaning that my substantive testing has to be up. Okay, so I thought I was here. No, when I did my walkthrough, I found out I was here. My risk of material misstatement is up. Got to bring my detection risk down. How do I do that? By increasing my substantive testing. So A is wrong. I don't decrease substantive testing, I increase it. And I do that to do what? To bring down the correct answer, my detection risk, okay? Increasing inherent risk is nonsense because at this point, either inherent risk or control risk has come up, and that's the problem. And how am I going to respond to that increase in the risk of material misstatement? By lowering my detection risk, the correct answer. Increased materiality levels is complete nonsense. And so I was a little surprised that a few of us took that. I mean, what would that do if I doesn't address the problem here of trying to lower my detection risk because of my higher risk of material misstatement? So it's not even on the same plane of consideration. Not only that, but what? Increase in materiality levels. So you mean to tell me that you're trying to lower your detection risk? So you're going to say, okay, my materiality levels were $500, but now they're $10,000. Well, now you just have much fewer transactions that will what? Be subject to your substantive testing. You've done the wrong thing. You've done the opposite of what you should be doing. And it's not even in the same plane of consideration here. Okay? Question. Okay, good. Now again, as we've said, when you are identifying your risk, okay, you're going to sit here and where am I? Sorry, I turned too fast here. Yeah, coming over, okay. When you are assessing risk, you're asking yourself, what could go wrong at the assertion level? In other words, what is the potential misstatement? And then you're responding accordingly. Okay, does that sound familiar? That is what? That's my little, and I think of all the documents that I show you, okay, this is probably the one that I show you the most, which is what? That little sales chart. I sit here and I say, hey, I have my account, I have my assertion, and then I use my imagination. What's the potential misstatement? Once I understand the potential misstatement, I look for the appropriate control, and the control lines up with the assertion. I'm looking for the control that is well suited to detect or prevent the misstatement in that particular assertion. I make a what? An evaluation of the control. I assess the control risk at the what? At the maximum, at less than the maximum, and I design my further audit procedures accordingly. Okay, so everything goes from the idea of the assertions, right? Okay, all right, good. Then we come over and they say, well, okay, now that you have the gone through the procedures of obtaining an understanding, then doing your further audit procedures during your testing phase, you have to document all that. Okay, so coming back to our textbook now, let's go ahead over to the next page and let's flashcard the required documentation. I like to flashcard required documentation part of the information because it reminds you what has to be documented if you get asked that. But it also is generally a very nice summary of everything that we've talked about. So we will have to have what? A discussion amongst the audit team. So you'll pull the audit team together and you will talk about the various risks that are associated, things that were observed, inherent risk, control risk, okay? Key elements of the understanding. What were they? What did you look at? The assessment of the risk and material misstatement, and it's done both at the assertion level and at the overall financial statement level. So that sales chart that I keep showing you, that might be a nice way to document how you assess the risk and material misstatement at the assertion level, okay? And then the identified risk and related controls evaluated by the auditor. Again, that sales matrix thing, as I call it, would be a good way of documenting this stuff. Okay. All right, good. Now, the book's a little out of order here because now they start telling us how to respond. And there are things that we talked about that should have been documented that are relevant to the response. Okay. Let's flashcard the responses. Okay. And the overall response and then the assertion level response. Okay, but let's look at the overall response and let's flashcard that. Communicate the audit team the need for professional skepticism, assign staff with more expertise. If you have what? If you have a high risk of material misstatement for the overall financial statement, you're going to want to assign staff that are a little more experienced. Increase the level of supervision. You're probably going to visit that audit site more if you're the partner, etc. Right? And you can flashcard these, they're pretty self-explanatory. Okay, for the assertions, then you're going to go ahead and you're going to what? You're going to line up audit procedures that respond to your assessment of risk at the assertion level. Again, I'm not going to put that sales chart up again because I think you're getting sick of seeing that. Okay. Okay, good. Come over, then your substantive procedures, and they give you the mnemonic: nature, extent, timing. Nature means the effectiveness of the procedure. If you have a higher risk of material misstatement, you're probably going to use external evidence instead of internal evidence. Extent, larger sample sizes. Timing, year-end testing instead of interim testing. Okay, the only reason I'm stopping there is just to have you fill out that mnemonic net. We've already talked about that. Okay. Now they talk about a substantive approach. Substantive approach is an abbreviated way of saying, I'm not going to test the operating effectiveness of the controls. I'm going to follow that red arrow and go straight to the substantive testing. Okay. So what happens? That would be the case. There are no effective controls. First jewelry shop, all they did was lock the door. There were no effective controls, so we didn't have to test them. Okay. The implement controls are assessed as ineffective. Okay, so what happens? They didn't implement the controls. We went to that, the two people came in and put the combination in by themselves. Now this one you see in multiple choice questions, and I find it annoying because it's highly unlikely that you could have a client in which it would be more efficient to go straight to substantive testing versus testing the operating effectiveness of the controls. Think about it. Let's say you had controls that had a potential to have operating effectiveness, and you say, well, no, it's more efficient for me to go straight to substantive testing. Really? So now nature, you're going to have to get external evidence, and you're going to have to have a lot of external evidence. So now what? Now you're going to your clients' customers and saying, please answer my confirmation. That can get costly. You're going to be doing your testing at year end then in that circumstance. So what happens? Right as you're trying to wrap up your engagement, you're engaged in a lot of year-end testing. You're probably incurring overtime, etc. When if you went and tested the operating effectiveness of the controls, you'd be asking management for internal evidence, both substantive and, of course, internal control testing is internal. So now management probably assigns somebody to work with you and get you all the information you want. Why? Because they want you the hell out of there so they don't keep incurring audit fees. And then what? If you're doing interim testing, now instead of your staff, I used to know this guy that worked for a CPA firm and used to tell me, dude, we weren't busy at all, so I snuck out and I went to the movies. Okay, and they didn't say that in December. He was saying that in some interim period during the year. Well, now you can take that guy and pull him in and say, hey, do some interim testing. You're not incurring overtime. So it's unlikely that it is more efficient to sit there and do your go straight to substantive testing if you believe the client has some internal controls that have the potential of having operating effectiveness. But the standards allow for it, so flashcard that. Okay. Okay, good. Now, when you do your audit, you can use a combined approach where you're going to do what? Test both the operating effectiveness if you believe the controls have the potential to have operating effectiveness, and the substantive testing always has to be done. Test of controls may be required, and that is the case in an IT environment. If the client has the disappearing audit trail situation and you don't have sufficient evidence to allow you to do a purely substantive approach, you may have to test the controls in order to be able to have sufficient evidence to be able to support your opinion. Okay, so in an IT environment, test of controls may be required simply because you won't have enough evidence to do the a purely substantive approach. Okay, come over. Okay, and I want to just go over to the next page. And when should I be performing the test? And test of controls are performed when the auditor believes the controls have operating effectiveness. In other words, I've assessed the risk of material misstatement at less than the maximum, or where we're in an information technology situation, which we've already talked about. Okay. Come down, some risk assessment procedures performed to obtain an understanding may provide evidence about operating effectiveness, even though they weren't intended for that purpose. We said that last time. Flashcard that. That's what happens in the walkthrough. So what happens? You sit there and you walk through a transaction. Well, you can use that as evidence of operating effectiveness. Now you'll have to supplement it with testing more transactions. That was at 49 additional days, but I don't have to throw away that one day that I was there to get up to 50 transactions being tested. Okay. Okay, good. If efficient to do so, it is okay to go ahead and test operating effectiveness concurrently with obtaining an understanding. That is frequently the case where you have a repeat client and you're already familiar with the controls, and now you're just making sure that they have continued into the next audit. Okay. Okay, good. Now, flashcard in a financial statement auditor, the auditor is required to obtain an understanding of the design and implementation of internal controls as part of the understanding. The auditor is not required to evaluate the operating effectiveness. However, that is only done if you believe the controls have operating effectiveness. Okay. Okay, good. Yeah, this is going to be too much. I wanted to kind of finish this whole thing. Yeah, we're almost there. We're going to go a little later, guys. I know you're ready for a break, but I want to go a little bit more so that we can finish this section before the break, because it's all one big thought process. Okay, so let's just keep going. Then we'll come back after. We'll take a break and come back after we finish this. But test of design and operating effectiveness. Okay, and so just come down. Nature of the test of controls. Testing of operating effectiveness controls presented in the order of evidence that they would ordinarily produce from least to most persuasive. So least is inspection, most is reperformance. Okay, now notice inquiry alone is not sufficient, and observation generally is pertinent only at the time of the observation. So we would have to supplement it with other procedures such as inquiry, inspection of documents, reperformance. Okay, so flashcard this, but let's just go ahead and look back at that slide set that we had earlier, and right here. Okay, so what I did here, kind of a half-ass thing, and trying to make a pyramid out of this. Okay, but what the most reliable control test is reperformance. If you reperform the procedure that's supposed to detect the misstatement, that's the best way for you to say, yeah, that's a good procedure. That would detect the misstatement. Okay. Observation is what? Is going and looking at those inventory control sheets and seeing if they're signed off on. So you observe that. Yeah. I take that back. Observation is the day you were there and you saw them do that procedure when both people came in. So you observe that, but again, that's only good for that one day. So you have to supplement that with what? Inspection. So now you go and you inspect all those inventory control sheets. Observation also could be looking to see that those cameras are working. Remember I said there was cameras looking at the whole process. So you look to see if they're working. Can I please see the files? Can I see the video files of that or that you have? Do you have electronically, digitally? I want to see that, right? Sometimes you ask that question and tell you, well, actually, the cameras aren't really turned on. They're more of a deterrent. Okay, so you probably want to do some inspection, inquiry, right? And that's where they're initially telling you how the controls work and stuff. That alone is not sufficient. You're going to have to do some of these other things. And the lower you're trying to get that control risk, the more you should be doing things at the top of this list, okay? And the more evidence you should have. So it's more better evidence, better, more reperformance, more evidence. I'm going to look at what? If I tried to take my control risk down from moderate in our little example down to minimum, instead of looking at 50 days transactions, I might look at 150 days worth of transactions, okay? And the more you want to get that control risk down, the more reperformance you're going to have, and the larger your sample size for doing your control testing, okay? Okay, good. Now you come over, and I gave you that flashcard. You don't really have to make the flashcard that I called out for you because you have it right there in that little pyramid, okay? But make sure you flashcard that inquiry alone is not sufficient, okay? Now, the frequency of testing of controls, just coming over, okay? And evidence obtained in prior audits, okay? And so let's go put this in full screen mode, okay? And if controls have changed since they were last tested, test them again. And even if controls have not changed since they were last tested, they must be tested at least once every 3 years. And that's a minimum. That's not a maximum. So you can't have a client say, you can't test these controls because I heard they should only be tested once every 3 years and you tested them last year. You can test them as every year if you want to, okay? But at a minimum, they must be tested at least once every 3 years, okay? Okay, good. Now you come over and the results of the test of controls and operating effectiveness can be relied upon. The auditor then proceeds to substantive procedures, okay? If they are not operating effectively, let's say you look at those inventory control sheets and the supervisor never signed off on it. Well, now they signed off that day you were there, but then when you pulled the sample to look at them, okay, this guy didn't sign them all the time. So what happens? Now you believe that the control does not have operating effectiveness and you will look for alternative controls, or you'll do what? You'll have to lower your detection risk by increasing the timing, extent, and nature of your substantive procedures. Flashcard that. Okay. Okay, good. Now coming over your timing of your substantive procedures. Okay, so now we're talking about substantive procedures. See how we've gone through, talked about obtaining an understanding, talked about testing the operating effectiveness. Now what? Now we're down to the substantive procedures. And if substantive procedures are performed in an interim date, the auditor should perform further substantive procedures that will roll forward to the end of the year. And remember, on the chart I showed you, hey, even if you do interim testing, you still have to roll forward to the end of the year, maybe do an analytical procedure for the back end of the year, or take a smaller sample size, but you can't just ignore, if you did your testing at 9:30, you can't just ignore the back end of the year. You'd have to do something there to roll forward, okay? Note here, if substantive analytical procedures are to be used, from interim testing to the year end, the auditor should consider, are things going to move uniformly? If you're sitting there and you're auditing a, let's say you analyze 3/4 of the year, and you're auditing a retail entity like Macy's, well, that's not going to tell you much that you audited 3/4 of the year. You're going to have to do something to what? Amplify the speed of transactions that happen for year-end holiday shopping and all that sort of thing. So be careful that, that if you're going to do the roll forward, that you account for any difference, any seasonal differences that could occur for that entity. Okay. Note that it works better if they're more predictable, okay, to year end. So you can flashcard that. And then if risk assessments are discovered at an interim date, you may then, misstatements, I should say, are discovered at an interim date, then, you're probably going to want to move to a year-end testing approach, because now you're getting information. Thank God you did some interim testing, because now you can adjust to the year-end to increase your substantive testing and whatnot, because obviously things aren't working out the way you thought. Okay. Flashcard that concept of rolling forward too. All right, good work, guys. Now, all I want to do at this point is put up question 2, because they have put up question 1 too early. So we will come back to question 1 a little bit later. But before we take the break here, let's go ahead and let's take a look at this question 2. Okay, guys, let's make a selection, you last couple of people. Okay, so let's take a look at this one. Okay, and okay, half of us got it right. And then there was a spattering of choices for some of these others. So let's just go ahead and let's take a look at this one. Sorry, my cursor is giving me a hard time here. Okay, let me get this out of the way. Okay, after performing risk assessment procedures, the auditor decided not to perform test of controls. Okay, now if I did my risk assessment procedures, then I have ended up making an assessment of the risk and material misstatement, right? And if I've decided not to perform test of controls, what is that telling me about my assessment of the risk and material misstatement?
It's high.
My RMM good must be up. So if my RMM is up, I'm going to try to lower my detection risk by doing what? Increasing my substantive testing, potentially. Okay, so I have to look and see which of the choices potentially falls into this. So the available evidence, let's look at A. The available evidence obtained through tested controls would not support an increased level of control risk. Well, why would I want to look for something that would increase my control risk? My control risk is already up, isn't it? Why would I be looking for something to increase it? It's already at the maximum after I perform my risk assessment procedures, because I'm not going to test the operating effectiveness of the controls. So I'm not looking for something that's going to increase control risk. I've already said I don't like to design. The controls were not implemented, so I'm not going to test the controls. And I'm certainly not looking for something that's going to increase my control risk, right? Okay. B, a reduction in the assessed level control risk is justified for certain financial statement assertions. No, it's not. No, it's not. I'm up there. I'm saying, in obtaining the understanding, doing my risk assessment procedures, I didn't like what I saw. Poor design, poor implementation, or both. D, the assessed level of inherent risk exceeds the assessed level control risk. So, and that means nothing. It's the interaction of the two, whatever they are, is what gives me the risk and material misstatement. So C, you look and you're like, okay, by process of elimination of understanding this, I've gotten to the correct answer, C, and oh, this is that unlikely case in which it would be what? Inefficient to perform tested controls that could result in the reduction of a planned substantive test. Okay, inefficient and that either the controls are not effective, so I'd be a fool to test ineffective controls, or I'm in this weird situation where I've determined it's better to move directly to substantive testing. But C is the right answer because A, B, and D are nonsense if you understand this. Question? You've got to grind through these questions, guys. The auditing exam, conceptually, the stuff that they're testing you on is not inherently difficult. What's hard is the way they sit there and they word these questions. You got to do your weightlifting on this stuff. You've got to get that strength up there. You can't answer questions like this by just, oh, let me halfway understand this. Oh, this looks pretty good. You're going to flunk. You're going to fail if you do that. You've got to build up that muscle tissue. It starts here in class, and you continue to develop that by working through your homework problems. Okay? Okay, guys, let's take a break, well-deserved break, and we will come back in about 10 minutes, okay? I'm going to pause the recording. Somebody please remind me. Okay, guys, we're gonna go ahead and get started back. I want to go back to the beginning of the chapter here because we had gone to look at audit risk before we were going to look at fraud risk. And the reason is that fraud risk is really a subset of our audit risk. Okay, so what happens when you look at errors versus fraud? Okay, and we see that what errors are unintentional, fraud is intentional. And what the standards are going to say to us is, look, you are responsible for finding a misstatement, whether caused by error or fraud. It's in the opinion that we memorized. But what they're telling us is this potential for fraud, we're going to have a little bit of a different mindset in how we consider misstatements that could be caused by fraud. So that's why I'm saying you're still assessing risk in a similar manner, but you're going to have a special way of looking at the potential for that misstatement to be caused by fraud. Now, when we look, there are two types of fraud: fraudulent financial reporting. That's basically lying, putting something down in the financial statements that is not correct, versus misappropriation of assets, that's stealing. Okay, and again, the standards are going to say, look, you have to identify a misstatement whether caused by error or fraud, but you're going to have to look at the potential for the fraud a little bit differently. Okay, so what they do for us in the standards is they come out and they tell you, look, there are certain fraud risk factors that when you see them, you should be determining how they're affecting the potential for there to be a material misstatement. And so our fraud risk factors are incentive and pressure, a reason to commit fraud. For example, if I get a higher net income, I'm going to get a better bonus. Incentive. Pressure. If I don't show a better net income, I'm going to get fired. These would be reasons for engaging in what? In financial reporting fraud. Okay. Opportunity. Lack of effective controls. I'm here to tell you that I believe this is the biggest cause of fraud. What happens? And it's the biggest cause of misappropriation of assets. If someone thinks it's going to be easy to steal something, they're probably going to do it. Eventually, somebody's going to try to do it. Okay, so you don't want to have weak controls that provide that opportunity. You leave the door open, someone's going to walk through it. Okay, rationalization attitude. Okay, and when we talk about attitude, you can put the word bad attitude. Okay, rationalization says what? I've worked here 30 years and never appreciated my efforts. Let me steal $10 million. Rationalization. Attitude. I'm the owner of this company and you're going to do whatever I tell you to. Bad attitude, right? Okay. Now, when we think about these, though, it is again important that we think of them in the context of the audit risk. And the audit risk is what? The risk of material misstatement times my detection risk. Okay. Now, what's happening? When we look at the risk of material misstatement, we're looking at inherent risk times control risk. So now we're still doing the same process that we talked about a minute ago, but now we're looking to see if any of these fraud risk factors affect the audit risk, the risk of material misstatement. Okay, so incentive and pressure. Which of these elements of risk of material misstatement do you think incentive and pressure is affecting? Inherent risk, control risk, incentive and pressure.
Control risk.
Okay, maybe I'm thinking it's an inherent risk. And who was that?
Matthew.
Matt, it's more of an art than a science. Okay. I'm thinking instead of in pressure, going to probably affect inherent risk, and that what? Well, I'm going to try to push through transactions. I'm going to try to recognize revenue early. I'm going to make transactions complex, etc. Right? Okay. Now, how about opportunity?
Control risk?
Good. Opportunity is affecting control risk. It tells us ineffective controls. So opportunity, if it's there, is driving up my control risk, right? Okay, and now it's driving up my control risk, but I'm seeing there's a potential for fraud now because I'm thinking in terms of these fraud risk factors. And if I see them, that's going to heighten my concern not only about a misstatement because of error, but now a misstatement because of fraud. Okay, good. And the other one was what? I'm going to just call it a rat bad attitude. Okay, and I'm being a little cute here. We're calling it a rat bad attitude. It's rationalization. What do you think? I think this is touching both of them. Because it could what? It could cause somebody to feel they can steal cash, which has a higher inherent risk, but it could make what? A manager having a bad attitude think that they're entitled to override the controls, right? Okay. So again, you know, this is not going to ask you, they're not going to ask you a question on the exam. Which of the following fraud risk factors would affect which of the elements of the risk and material misstatement? They're not going to ask it that way. What I'm trying to get you to understand here is the mindset that's going on. We're still assessing risk and material misstatement, whether caused by error or fraud. And if you see these fraud risk factors, those fraud risk factors are driving up the potential that there will be a misstatement caused by fraud. And now the auditor is going to have to react accordingly. That's where we're going with this. Okay. So you come over and you take a look and let's see what they tell us. And they remind us, hey, reasonable assurance, concealment aspects, etc. because of fraud. Okay, it's always a potential. You may fail to detect fraud. Audit risk is never zero. Risk and material misstatement is never zero. So in expressing an opinion on the financial statements, we are providing reasonable assurance that the financial statements are misstated, whether caused by error or fraud. So we don't come in and say, we're going to catch the fraud. We come in saying, hey, we understand the financial statements could be misstated because of fraud. We've been guided by the standard to tell us what kind of fraud risk factors are out there, and we're going to consider how those are driving up my risk of material misstatement. Okay. Okay, good. Now you come over and management has responsibility to implement programs. And those programs and controls will prevent, detect, deter fraud. Now, I want you to flashcard that, but I underscore they're supposed to implement programs and controls. Notice that even management can't tell you, there will never be fraud. They put programs, they pray, they put programs, they put controls in place, and they know that they're responsible to do that, but they're hoping that those programs will prevent, detect fraud. So there's nobody can guarantee you that there's not going to be some sort of fraudulent financial reporting or misappropriation of assets. It is management's responsibility to put programs that will help prevent it, okay? And it is the auditor's responsibility to obtain reasonable assurance that the financial statements are going to be misstated, caused by error or fraud. And so that means that the auditor is going to have to specifically assess the risk of material misstatement by fraud. So not only do we assess the overall risk of material misstatement, we're going to have to document a specific assessment of the risk of material misstatement that the financial statements are misstated due to fraud. And this is an ongoing process, guys, in every phase of the audit. So not only, and we're still in the planning phase, so not only is the auditor considering fraud in the planning phase, but that goes on throughout the audit until the day the report is out the door. Okay. Now they tell us that there are specific audit procedures that we should perform in making that assessment of the risk and material misstatement due to fraud. I want you to flashcard these. Okay, so we will have a discussion with the engagement personnel. That's our team, our audit team. Obtain information to identify specific fraud risk, assess fraud risk, and develop the appropriate response. Again, we have to assess fraud risk. We have to respond to that assessment. Continuing on to the next page now. These are all one big flashcard that's sitting here calling out the fraud procedures, evaluate evidence, make appropriate communications, and then document. Okay, so what we're going to do here now, since I had you do that high-level flashcard, is we're going to come through and talk a little bit more about each one of these elements. Discussion amongst the audit team. It's a brainstorming. How could fraud be perpetrated? Okay, where are the financial statements susceptible to misstatement due to fraud? I was on an engagement one time where we were looking at the regional finance center for the federal government and the cash disbursement process, and they have regional finance centers throughout the country, including San Francisco. So we led work out of San Francisco. So you go to a regional finance center, and it's a factory, and the factory is producing what? Checks. Live checks. The checks sit on a spool of 40,000, and they just sit there and run off all these different checks. The checks get cut. They then go to envelopes. They're stuffed in envelopes, all mechanically get stuffed into envelopes. The envelopes then go off and get mailed to whoever the recipients are. You can't help but walk through there and think, wow, I bet you there's a check here for $10 million, right? And so when we come back to our office, the comment is, how would you get a check out of there? And the guy sitting next to me had it all figured out. Okay, I was thinking, I don't know, drop it in your lunch pail when no one's looking. No, the guy had it all figured out. All you need to do is get check stock and and he had the whole thing figured out. So what we started doing was identifying some weaknesses there. Now, when we issued the report, it was a limited use report. And limited use report means it's only going to Congress. It's not published to the general public because we don't want the general public to know how you could steal a check, a federal check from one of the regional finance centers. But we went and looked at all 5 around the country, and we found some things like, for example, okay, they weren't locking up their check stock at the end of the night. To them, that big old spool of 40,000 checks was just a piece of equipment they used, a piece of material they used in a mechanical process. Meanwhile, it was live check stock. So we told them, hey, you got to lock that stuff up, etc. And that all came, those findings, and that really kind of went beyond just the financial statement audit component of what we were doing, because GAO, Auditing Arm of Congress, we report things to Congress that are going on that could be improved in the government. That brainstorming, though, led to that additional work that we did on that particular engagement, okay? So you have that brainstorming, okay? The sharing of ideas, etc. Okay? As part of that meeting, there will be an emphasis on the importance of professional skepticism. Again, if somebody tells you something that doesn't make sense, you're going to have to inquire some more until you get to the bottom of how things are supposed to be working, right? Consideration of factors that create incentive or pressures to commit fraud, opportunity, right? Are the fraud risk factors present, right? Okay. And consideration of the risk of management override of controls and how the auditor might respond to those identified fraud risks. And then discussion of all key elements of the audit team, including the engagement partner. Engagement partner really leads that discussion. Okay, so that just gives you a sense of that discussion. Now you start to obtain information. And you start by inquiring entity personnel. That's the employees of the client, okay? And you'll ask them, what is your thoughts on the overall fraud risk? Identified or suspected instances of fraud. And how you ask that question is important. You say, do you say, was there ever fraud? They're probably gonna say no. You say, can you please tell us about instances of fraud, right? Then they're like, oh, okay, he already knows about it. Let's go ahead and just, spill our guts here, okay? So you want to make those appropriate inquiries, okay? You want to understand the involvement of the audit committee, okay? It's their job to provide the appropriate oversight, okay? Now, you will consider analytical procedures. Now, remember we said last time, or whatever time it was, the time before that, whatever, that you are required to perform analytical procedures in the planning phase. Remember we said that? You have to perform analytical procedures in the planning phase. And now they're telling us that during planning, there will be analytical procedures over revenue. Why are they picking on revenue here in the fraud standard? Well, when was the last time you heard about fraud in the office supply account? You hear about fraud, what? Revenue recognition. That's the area where there's probably going to be some bias with management or some potentially fraudulent activity, okay? Now, when you do these analytical procedures in the planning phase, guys, they're at a high level, okay? It's at a high level that you're going to do these. So you're going to compare last year to this year, budget to actual, these sort of things, okay? Still at a high level during the planning phase, but you must go ahead and do analytical procedures as they relate to revenue, okay? Then you will evaluate the fraud risk factors. Where the fraud risk factors: incentive and pressure, opportunity, rationalization attitude, right? Now, I'm going to ask you to flashcard this, but it's sort of common sense. It's a little annoying, okay? Just because you don't see the fraud risk factors doesn't mean that there hasn't been fraud. And just because you see the fraud risk factors doesn't mean that there is fraud. It simply means that, hey, you're now becoming concerned that fraud is increasing the potential for material misstatement, and you're going to have to respond accordingly, okay? Now, once you have identified the fraud risk factor, you've seen the fraud risk factor, now you're going to have to look at the attributes of that risk, okay? So, what is the type of risk? And flashcard these. Is it misappropriation of assets, or is it fraudulent financial reporting? What is the significance of the risk? Can it lead to a material misstatement? Look, you're not going to worry about risk because somebody's stealing pens, okay? You could sit there, drive yourself nuts. Oh, well, I got to be careful of the paper supply, okay? No, is it going to lead to a material misstatement? That's what you're worrying about, the significance of the risk. What is the likelihood of the risk? If somebody is going to have to jump out a window with 40,000 checks strapped to their back, that's not going to happen, okay? So you're looking for the likelihood of the risk, and then you're looking for the pervasiveness of the risk. Is it going to affect one assertion, the entire financial statements? Notice, guys, these are not the fraud risk factors. These are what? Attributes of the risk. You found a fraud risk factor. Now you're cutting it open and you're looking to see what are the attributes. Is it going to lead to material misstatement? How likely is it to happen, etc. Okay. Now come over and flashcard that there is a presumption of the risk of improper revenue recognition and management override of controls on every engagement. So what does that mean? That means that you're going to have to assume that those things have happened, and you're going to have to design audit procedures around the presumption of risk in those areas. Why? Can you say Enron, revenue recognition? The management was warned about it, and what did they say? Don't worry about it, forget about it, and they overrode the controls, okay? So now the standards are saying, well, since auditors have had a little trouble figuring out when this is happening, just presume it is and respond accordingly, okay? The programs that are put into place for fraud detection will really depend on these, to detect, prevent, deter fraud will really depend on the size and complexity of the organization. More size, more complexity, we would expect there to be more programs in place. Smaller, less complex, maybe not so much, okay? Okay, good. Flashcard also down here, that we are worried about things that are complex or have a what? High degree of subjectivity. For example, estimates could be more subjective or have more susceptible, I should say, to fraud because, hey, management can fudge estimates. Complex areas in accounting. Oh, well, we got all this, you know, sophisticated derivative instruments or something, harder to understand, maybe a little easier for them to perpetrate some sort of fraudulent financial reporting on you. Okay. Okay, good. Now we go ahead and we assess the risk, and the auditors is required to obtain understanding of the entity environment, including internal controls as part of planning, right? And what specific controls may mitigate specific risk, we identify a control deficiency that may increase fraud risk. So we're really talking about doing a lot of the same things that we were doing before, but now we're looking at them in the context of, well, are they manifesting in the form of fraud risk factors that's going to increase the potential misstatement due to fraud? Now, let's say you found you identified fraud risk factors, and you think that there is an increased susceptibility to fraud on that engagement. Now you have to respond at an overall level. Overall level is things like, how are you going to staff the audit? So let me ask you, this is your first audit in which you're the partner. I'm going to make you a partner. We make someone partners. The first audit in which you're the partner, and you have to decide to assign personnel to the engagement. Raphael, are you going to assign more experienced staff or less experienced staff?
More experience.
Good. More experienced staff. Good. Okay. Are you going to visit that audit site more or less?
I'd say more.
Good. I picked the right person for partner. Okay, good. So you're going to sit there and you're going to do what? You're going to have more increased supervision. You're going to assign more experienced staff to the engagement. Good. Okay. I'm not going to go through every single one of these guys because I think how you would respond at a general level is pretty self-explanatory. So you can go ahead and flashcard that. But then you're also going to have to respond at a specific assertion level. So I'm seeing the fraud risk factors driving up my inherent risk and my control risk. How am I going to respond at the assertion level? Do you know how to respond to increased inherent risk and control risk in an audit? Forget about fraud. Really? You don't know how to respond to increase in inherent risk and control risk?
You'd have an increase of an RMM.
Well, that's right. I have an increase in RMM. How do I respond?
Decrease the detection risk.
Good. I decrease the detection risk. Excellent. How do I decrease detection risk?
Increase the substantial testing.
Good. How do I increase substantive testing?
Nature, extent, and timing.
Good. Excellent. Is that what it's saying here? Okay, so now instead of it being, you know, non-fraud risk factors that are driving up my RMM, it's the fraud risk factors that are driving up my RMM. How am I going to respond? I'm going to lower my detection risk. What am I going to do? I'm going to sit there. I'm doing year-end testing. Nature, I want external evidence. Extent, larger sample sizes, but now you're doing it in response to what? To fraud risk factors driving up your risk of material misstatement. Good, excellent, okay? So let's go ahead and see how we'll respond, and let's go ahead and flashcard responding to management override of control, since there's a presumption that there will be that. So we'll examine journal entries, review accounting estimates for bias. Okay, what is the business purpose for an unusual transaction? Maybe it's a bribe or something, right? Okay, so flashcard that. Okay, okay, good. Now you come over and evaluate audit evidence, because we're talking about doing this in the planning phase, but notice that they tell us, hey, this goes on throughout the engagement, okay? So if during the engagement, you start to encounter things like discrepancies in accounting records, conflicting or missing evidential matters, problematic relationship with management, frequent changes in estimates, tolerance of violations, what are they saying to us? As you are going through and doing that engagement, whatever it is, the key thing is you will always need to go back and say, did I assess the risk of material misstatement due to fraud at a high enough level? And if you look at these things and you encounter these things, even though you're now in the testing phase, you will do what? You will go back and you will reassess and make sure that you made all the correct decisions about the nature, extent, and timing of your audit procedures at that point. Okay? Then you are required to do a set of year-end analytical procedures. You have to do them at the beginning of the audit. You have to do them at the end. And you're looking for something that might be unusual as it relates to what? There's our buddies, revenue and income again, tend to be where fraud ends up being perpetrated. Okay? Now, if you find a misstatement due to fraud, now do you have to ask yourself anymore if there's a misstatement due to fraud? Now you know that there is, okay? And so that could have an impact on your assessment of management's integrity. And if that's the case, now again, reevaluate all of your assessments, because it's no longer, gee, I wonder if I have a management that would engage in fraud. You found it, okay? And then final evaluation, that's done near the completion, and it should include communication amongst the engagement personnel and any additional audit procedures, okay? And note, in situation where there may be significant material misstatement because of fraud, the auditor should consider withdrawing from the engagement. Flashcard that, okay? We haven't talked a lot about circumstances that will lead you to withdrawing from the engagement, but if you've got significant instances of fraud, it's not a game, okay? It's not, oh boy, let me see if I can ride this pony, okay? No, just withdraw from the engagement. Cut your losses at that point. Don't sit there and try to ride the thing out, okay? Now, once you have identified fraud, okay, then it needs to be communicated, and it's going to be communicated within the company, okay? So generally, it is discussed at least one level above those involved. So if it's the staff, you discuss it with the supervisor. If it's the supervisor, you discuss it with the manager, whatever, right? Now, what happens though if the fraud involved a scheme to steal $10 million and you find out that the staff did it? Are you going to take that to the supervisor? I mean, the supervisor maybe makes a little bit more than the staff does, right? So if you have fraud that causes a material misstatement, that now needs to go directly to management and those charged with governance, the board of directors. And if it involves senior management, that needs to go to those charged with governance. Okay. Now the auditor should also consider whether any identified fraud risk factors represent a deficiency in internal control. And I think they would. And so that would need to also be communicated to those charged with governance. Now, it is on rare occasion that you go and you report fraud to parties outside of the entity. So we're really hoping the corporate governance structure works, but let's flashcard the sort of set of circumstances here that would lead to you discussing the fraud that you've identified with parties outside of management and those charged with governance. In other words, go outside of the entity. So sometimes there could be specific SEC litigation requirements. Remember, we said that when the predecessor, when the successor is taking over the audit from the predecessor, there are certain inquiries that the successor has to make of the predecessor. And one of them was what? Any instances of fraud. So as a predecessor, you would be required to disclose those to the successor auditor when they make their inquiries. In response to a subpoena, there is no CPA client privilege. Okay, if there's something involved and you get subpoenaed, you're bringing your work papers to court. Under the Single Audit Act, there is a specific requirement that you report fraud to a funding agency. So if an entity receives expends more than $750,000 in federal financial assistance from the federal government, the Single Audit Act requires that an auditor come in and look to see that that money was spent appropriately. And if there's fraud, the agency that provided that money requires that you report that, or the Single Audit Act, the law requires that you report that to the entity that reported, that provided, I should say, that funding. Okay, and then if it's just something that just needs to be reported, you've identified some sort of discrimination or something. These things as a society we've decided are just too far beyond the pale that we're going to have to report them. Okay, good. Now you come over and take a look at the next page, and let's just go ahead and look at what needs to be documented here. Okay, and again, I always like to flashcard the documentation plus 10-point area, fraud, risk assessment. We've determined that we're going to flashcard practically the whole section here, right? Or at least a lot of the key points here. Okay, so document what was the planning discussion, that brainstorming that was done, or the procedures obtained to perform to obtain information, inquiry of the personnel, specific identification of risk of material misstatement due to fraud. Yes, we will have to say the RMM due to fraud is high, medium, low. You have to document that. Okay. Hey, if you haven't identified improper revenue recognition, why not? That's interesting because usually standards say, hey, document what you did, say what you found, right? Here it's what? Hey, explain to us why you didn't find something, because there's a presumption of improper revenue recognition, right? The results of procedures for management override controls, other conditions that warranted further audit work, and the nature of any communications. Okay. And Sarbanes-Oxley says if you destroy work papers, you will be showering with strangers. In other words, you're going to be subject to prison. Okay. All right, good. With all that, then let's go ahead and let's look at this. This is kind of a JIT. They give us one question in an area that is easily a 10-point area on the exam. You will see task-based simulation on this. You will see multiple choice questions, but they just gave us the one to practice with here. So let's go ahead and let's take a look at that. Okay, guys, go ahead and make your selection here. Okay, good. Yeah, most of us got it right. Okay, but let's just go ahead and let's look at these. A is the correct answer. Okay, but let's just take a look at this one. Which of the following best describes the auditor's responsibility to detect error or frauds? And let's go ahead and let's start at the bottom. An auditor has no responsibility to detect errors and fraud because an auditor is not an insurer. Really? No responsibility to detect errors or fraud. Then why are we here? Okay, we obviously have some responsibility to detect errors and fraud, or why bother even have an audit? C, an auditor has no responsibility to detect errors and frauds unless analytical procedures to test transactions, identify conditions, causing a reasonably prudent auditor to suspect that the financial statements, come on. What is all that? Okay, an auditor has a responsibility to detect material errors, but has no responsibility to detect fraud. Yes, we do. We are here to detect errors, whether caused by error or fraud. An auditor should obtain an audit to provide, nice phrase, reasonable assurance of detecting error and fraud that are, yeah, that's exactly what our responsibility is. That's right out of the standard, okay? And you should always be suspicious of something that starts telling you that the auditor has no responsibility. What is this? Auditor's gone wild? What are we on vacation here? Okay, obviously we have some responsibility for many of these things. It's rare that an auditor has no responsibility. Okay. Question? Okay, good. Let's come over then and let's take a look at, and we already looked at audit risk. And you can kind of see, I think now, why I kind of went out of order, because they were sort of relying on our understanding of something that was yet to come. So I'm not sure why they put that in order like that, out of order. Okay, but let's go ahead and let's look right here now. And I think this is a better order too, because we've been talking about fraud. And so now we're going to start to try to understand the auditor's responsibility of detecting misstatements because of non-compliance with laws and regulations. Okay. So as we said, for fraud, it is management's responsibility and those charged with governance to ensure that the entity operations are considered in accordance with applicable laws and regulations, right? It is the auditor's responsibility to obtain reasonable assurance that the financial statements are free of material misstatement, now due to non-compliance. However, this is an important however, the auditor is not responsible for preventing non-compliance and cannot be expected to detect non-compliance with all laws and regulations. The further removed the non-compliances from the financial statements, the less likely is the expectation that the auditor will identify that non-compliance. So let me ask you this. Are your clients supposed to file tax returns?
Yes.
Okay. Would it be reasonable to expect that the auditor would detect if the client didn't file their financial statements? I mean, file their tax returns?
Yeah.
Yeah. I mean, if you're going to be looking at the client's reporting of their deferred taxes, what are you going to say? May I please see the tax return so I can figure out the current portion of the tax, right? Oh, well, we didn't file it. Okay, so there's a reasonable expectation that the auditor should detect that non-compliance. How about if your client isn't following the occupational safety and hazard regulations, either by the state or the federal government? You might stumble into that, but there's no expectation that you design procedures around every potential compliance issue, right? So the closer the financial statements, the more the expectation that you will identify non-compliance. Okay. Okay, good. Now let's go over and let's take a look at this flashcard here. Okay, oops, I want that to be a flashcard. Okay, and let's just take a look at it. And many laws and regulations relating to an entity's operations do not affect the financial statements. Non-compliance may be concealed by collusion, and when an act constitutes non-compliance, that's a matter of legal determination. So you may ultimately need to defer to legal counsel to determine if something actually is a violation of law or regulation. Okay. Okay, good. Let's look at audit procedures related to non-compliance. Okay, and when obtaining an understanding of the entity and of its environment, the auditor should understand what? The legal regulatory framework. That's part of the environment, right? The auditor should obtain sufficient appropriate audit evidence regarding material amounts and disclosure in the financial statements that are determined by provision in law and regulation to have a direct effect. So if there's something that comes out and tells you, hey, that has a direct effect, then obviously you're going to have to make that understanding. Direct effect meaning the idea like the tax return versus the OSHA requirements, the occupational safety laws. Okay, the provision of laws that have an indirect effect on the financial statements, but have a fundamental effect on the entity's operation, the auditor should perform the following procedures to identify instances of non-compliance: inquire of management, inspect correspondence with relevant licensing and regulatory authorities, and the auditor should consider evidence gathered in other audit procedures that may reveal instances of non-compliance. So again, direct things, yes, they're absolutely expecting. Indirect, you should do some limited procedures there, like make some inquiries, etc. Okay. If you find non-compliance, okay, suspected, you should talk to those one level above involved, and if it's involving senior management or whatnot, then you're going to have to go to those charged with governance. Reporting of non-compliance generally does not happen outside the entity, so generally it's going to be reported to those charged with governance. Okay, if it's involving senior management, it's going to go to those charged with governance. Flashcard that. It is rare that you'll report it to regulatory or enforcement entities unless it's in response to inquiry from an auditor to a predecessor, in response to a court order, in compliance with the requirements for audits of entities that receive federal financial assistance. They specifically ask for that in the Single Audit Act. Now I'm flashcarding these. You know, if you find that your client committed murder, should you report that? Of course. Okay, so it's not like, well, hey, you know, it's not in response to inquiry, it's not in response to court order, it's not, you know, I'm not having to report it to a federal agency, so I'm just going to pretend like I didn't see a dead body in the closet. You know, if there are things like that that are so beyond, you know, acceptable society norms and whatnot, then the expectation is that you would report that to the appropriate authorities. Okay. Okay, good. If something has a material effect on the financial statements because of non-compliance, qualified or adverse, insufficient evidence, disclaimer, or qualified scope limitation, right? Okay. If the client refuses to accept the audit report as modified, then you're going to have to withdraw from the engagement because they're not accepting the report. You've got some qualification you need to make, then you're going to have to withdraw. Be careful, guys, because withdraw is the atomic bomb of solutions in an audit. So be careful, because sometimes you'll be reading a question and they'll indicate some problem, and withdraw from the engagement will be a choice, and you'll be like, yeah, just withdraw. No, withdraw is like, you know, key phrases. The client refused. You know, the auditor asked for something and all that they heard from management was a door slamming. Okay, these kinds of things are what causes withdrawals, not a disagreement with management about how something's going to be disclosed, you know, if that's the case, you can qualify your opinion. But if management says, well, I'm not going to accept the report, yeah, then you have no choice but to withdraw. Okay. Okay, good. Let's take a look at accounting estimates. Okay. And estimates basically are imprecise. They're based on management judgment. Okay. So the degree of estimation uncertainty could lead to risk of material misstatement. And they said it could be based on unintentional or intentional susceptibility to bias. I'm like, well, if you're biased, that's kind of heading more towards intentional, but I guess they're just trying to be polite here. Okay, so identify and assess risk of material misstatement due to estimates. Okay, and so let's take a look at things that won't really have a lot of estimate uncertainty. So accounting estimates arising from entities that engage in business that are not complex, so not complex things, things that are routine, okay? Accounting estimates derived from published interest rate data, et cetera, published data, okay, et cetera. But what we're probably more interested in is, well, what will have a high degree of estimation uncertainty? So the outcome of litigation, fair value of things like derivatives, right? Fair value for which there's high specialized entity development model, okay? These sort of things are going to lead to more estimation uncertainty because maybe, you know, you're not really dealing with the area that's been well established. I'm going to be teaching a class this summer at Stanford, and it's basically for a master's in medical technology. So we're really looking at issues surrounding disclosures related to uncertainty, such as will the product be funded? Will the product, you know, have support of insurance? So you have to start to look at certain risks and uncertainties and make sure that those are properly disclosed. And it gets a little tougher to get around those estimates when you're dealing with emerging industries, that kind of stuff. Okay. Okay, good. Coming over, the auditor should look for indicators of possible management bias, okay, and consider that as part of the process of looking at the estimates. Indicators of possible bias, okay, and you can go ahead and flashcard. And they say change in accounting estimates or the method of making it, but if it's an emerging area, that might not be that surprising. But if they seem to be changing it for no real well-documented reason, that could give you concern. Continue the flashcard here, the use of an entity's own assumptions for fair value when there are observable market inputs, selection of construction of significant assumptions that yield a point estimate favorable for management objectives, such as getting a bonus, selection of a point estimate that may indicate a pattern of optimism. Okay, okay, good. Flashcard that. Okay, again, estimates with low estimation uncertainty result in lower assessed risk. Higher estimation uncertainty, what is going to have a higher risk of material misstatement? That's almost so self-explanatory that I almost don't want to ask you to flashcard it, but I'm going to go ahead and ask you anyway to flashcard that. Okay. All right, good. Let's take a look at evaluating let's do it, guys. I want to do it because I want to finish the module so that you can do all the homework for that module without running into things that we haven't talked about. Okay, so evaluating contingencies. What are contingencies? Threatened litigation, possible claims assessments, guarantees. Okay, how do you identify contingencies? Okay, and contingencies are either going to have to be booked in the financial statements or disclosed. Okay, so first step, the auditor should ask management about contingent liabilities, including pending litigation, possible future litigation, etc. So the first step is just expect management to tell you about them. Okay, now you don't stop there, of course. You also will review minutes, review correspondence, invoices from lawyers, right? Hey, why do you have this legal fee that seems a bit high? What's going on, right? Looking at loan agreements, bank confirmations. We'll talk about bank confirmations in a later lecture, but we're going to see on the bank confirmation, will be a discussion. Are there any outstanding loans? Okay, so you'll look there. Okay, discuss long-term purchase commitments, looking at leases. All of these are ways of identifying potential contingencies. Okay. Okay, good. And you can go ahead and look at a couple more of these on the flashcard. Review interim financial information. Sometimes things find their way into the interim reports easier than they do into the year-end reports. So the interim reports may be being prepared, and as part of your year-end procedures, you may be acquiring those interim reports and taking a look at those. Okay. Now, the key thing is get a client representation letter. Remember, I said that that happens at the end of the engagement. And at the end of the engagement, you make management give you a letter that says, we've told you about all the things that are hard to audit. So things that are hard to audit are things like, hey, are you subject to some sort of lawsuit or something? So we make them put in the management rep letter that they've told us about all litigation, claim, and assessment. Also, we will send a letter to the client's attorney, okay? And we will do that near the end of the audit. And we're going to ask them, hey, are there any litigations, claim, and assessments, et cetera? Okay, now that has to happen. We're going to get more into that in A5, but that is really a key step for identifying any litigation, claim, and assessment. Okay. Now, we will then make specific inquiries to litigation, claim, and assessment. So what is the legal action, whatever, degree of a probability of an unfavorable outcome, and the amount or range of potential loss, and depending on how that stacks up, it may need to be disclosed or it may need to be booked in the financial statements. Okay, you could go ahead and flashcard that. Related party transactions. Okay, now related party transactions. Okay, when auditors are performing an audit of the financial statements, they are responsible for identifying related party transactions and determining that they have been properly disclosed in the financial statements. So that right there, flashcard that, is telling you it's okay for an entity to have related party transactions, but they must be what? Properly disclosed. Okay, and related parties may be affiliates, members of management, their immediate families, etc. That's what we mean by related parties. But again, it's okay to have related party transactions, but they have to be properly disclosed. Okay. Now, what's interesting is the audit procedures. Okay, and you would think, oh, okay, well, there's going to be some specific procedures around identifying related party transactions. And then when you look at it, it's really relying to a large extent on the entity's process for identifying related party transactions. Now, what you'll do is you'll request management the name of all related parties, okay? And you could also review SEC filings, because entities are required to report who their subsidiaries are to the SEC, assuming, of course, they're a public company. Review material transactions for related party evidence. Okay, now what happens? It's kind of interesting because you request the names of the related parties, and then you provide that list of names to the audit staff. And the audit staff may be just looking at loans receivable. But because they have a list of related parties, they'll say, well, wait a minute, this loan receivable is from somebody who's a related party. So as they're doing work in other areas of the audit, they're checking against that related party listing that you got from management. And if they identify a transaction with a related party, then we're looking to see that it is properly disclosed. Okay, so there aren't specific set of transaction level types procedures that you do related to related parties. You're doing other areas of the audit, and then you're comparing that to the known list of related parties. Okay, now the impact on the auditor's report. And if management puts this silly statement in the financial statement that, yeah, it was a related party transaction, but the terms of the transaction were the same as they would have been had it not been a related party, then you have to qualify or adverse. Now, what does that tell me? Qualified or adverse is telling me that the accounting standards related to related parties specifically prohibit that kind of a statement in the financial statement. So if management went ahead and put that in the notes, you will qualify or adverse. Okay. And then you're going to document the names of all the identified related parties. Okay, include that in your audit documentation. And that's something that probably would go in the permanent file so that you have those from year to year. Okay, because that's probably something that's going to be useful to you in future audits as well. Okay, now, once you have identified a related party transaction, is there anything wrong with that? No, if they have a related party transaction, okay, you will have provided the audit team with the names of the known related parties. And if something is identified, such as a loan guarantee, you have to make sure that it is what? That it is properly disclosed. Okay, so once you identify, you're going to what? You're going to go ahead and inspect the business rationale, the terms, the transaction has been appropriately accounted for and disclosed. That's ultimately our objective. So again, provide the step with a list of related parties. They're doing other parts of the audit. They're auditing accounts receivable. They're auditing notes receivable, notes payable, whatever. And that name comes up as a related party, the party related to that transaction they're auditing. Then you're going to do these procedures and make sure you're satisfied that it's properly disclosed. Okay. Now this part is kind of interesting. If you identify a related party that management didn't disclose to you, you're going to communicate that information to the management team, request management to now tell me all transactions that happen with this related party. Inquire, why didn't you tell me about it, right? Management integrity. We don't want to be involved with a management that isn't giving us the full list of information we need to do our audit, right? Perform appropriate substantive procedures. Maybe now I have some problem with management because they didn't provide me the information that I needed. And so evaluate the implications on the audit for that non-disclosure. Okay. All right, guys, let's do this one last question here, and then we're going to call it an evening. We're already late, so try to answer this as accurately as possible here, and we'll get out of here. Okay, guys, let's do your best to wrap this one up. It's getting a little late here. Okay, good. I'm going to go ahead and share the results. And yeah, pretty much everyone got this right. I think that, you know, some of these choices are just a little silly, but reviewing confirmation of accounts receivable for indications of a guarantee is an obvious related party type of a transaction that then you would expect the appropriate accounting and disclosure on that. Okay. All right. One more thing before we get out of here. Module 7 on ratios. I want you to look at that on your own. I'm not going to go through that with you. We'll come back and finish up chapter 3 next time, but I am not going to look at the financial ratio module with you. It's fairly self-explanatory. Watch the pre-recorded lecture of that. And I'm thinking that this weekend you'll have time to do that because we've had a little bit of a lighter week. So you should be able to look at the financial ratio module on your own. We'll come back next time and pick up with module 5, 6, and then, like I said, you'll look at 7 on your own, and then we'll get into 8 together next time. Okay, question?
I'm sure it's already on your radar, but the auditing 4.0 came out, and some of the stuff from A2 was changed, is what it looks like. Well, are we gonna?
Okay. Well, we're not going to go back, I don't think, and redo anything because we're not going to have time. But what I am going to do is look forward as to things that maybe we won't emphasize as much. And then I'll have to give you some kind of indication of things that I think that are significant that have changed. So you can look at that accordingly for July 1st. But I can't start going back and redoing, you know, things as we're going to run out of time.
Fair enough.
But yeah, I do need to do that. I want to look at things.
Do you recommend us ordering the books now?
Yes. Yes. You can go and order the book now. In your software, redeem. Yes, do that. Okay. Question? Okay, guys, have a good rest of the week, and I will see you on Monday.
Thank you.
Bye-bye.
Good night.
Thank you.